Welcome to all the participants for joining us for what should be a great interactive session and knowledge sharing discussions on some of the recent developments concerning foreign portfolio investors that are FPIs that are set up in Mauritius. There obviously has been so much of development that we would hope to take each of them through separate buckets and pick up some of the issues that has been key for a lot of fund managers who are looking at India using the FPI program. So I think to begin with, I thank all my panelists also who are joined the session, and obviously welcome all of you and hope you are having a safe and healthy and you're safe and healthy in these unprecedented times. So I think to begin with, the focus with COVID has, along with all of us being at home, has also been the actions taken by the government as a response to COVID, which has been of most interest. To begin with, while travel has been restricted, international travels is completely out. Domestic travels obviously is also extremely limited for very select groups of constituents and definitely not for businesses and fund managers. What has been of interest is how the governments have been reacting to the different issues being thrown up by COVID. On one hand, we have seen Indian government looking at foreign investors with both arms open. We have seen Mauritius being sort of been upgraded as to be at par with being a member of Financial Action Task Force FATF, and we will discuss what are the implications coming out of it. On the other hand, we are also seeing the regulator being open to take a lot of feedback from the industry and the constituents on what else can it do to encourage foreign inflows into India. As a lot of you may be aware that supply chains are being rejigged globally, and there is an expectation that maybe $500 billion of cash flows or investments may come India's way as more and more jurisdictions, countries globally try to rejig the supply chains and a lot more focus comes to India. So obviously the regulators have also been trying to open up the laws so that it is in a position to absorb all this capital, which is hopefully expected to flow into India in the next 2 to 5 years, short to medium term. On the other hand, in addition to encouraging capital inflows coming to India, the regulators, and India is not in isolation, have also been taking slightly pessimistic views on or discouraging certain activities. Key point to begin with was the restriction on short sales that we were seeing globally. Regulators were coming up with laws which would have discouraged or limited taking short exposures, short positions, or any instrument which would deliver a financial advantage in the event the price of certain stocks were to fall down further. So that was the ban on short sales in some jurisdictions, enhanced monitoring in some other jurisdictions, reduced position limits in case of India, and so on and so forth. The other reaction that the regulator has also done is that they do realize that there are a lot of companies which are operating on the listed space, but yet they are very critical constituent of some of the sensitive sectors that we have. Accordingly, the regulators globally and India also very recently has introduced some sort of vetting process where the government looks to vet certain foreign investments coming into India. If those investments are being made by an investor from any of the countries which are India's neighboring countries, or if the investor may not be out of a jurisdiction which is India's neighbor, but at the same time is a beneficial owner from the neighboring countries, and so on and so forth. Again, that is a very interesting discussion by itself. But what is of much more keenness is how India has gone ahead and implemented that, and so on and so forth. With that, I would now look at Kishore Joshi. Kishore, maybe if you could summarize for the audience that FPI regulations were introduced in 2014, and this was recently revised in 2019. Now, what in your view are the key highlights of the new regulations in 2019, and And obviously, this should tee up to why FATF was the way the regulator chose to sort of classify different FPIs. So I think maybe if you can share with us your thoughts on some of the key features concerning the new FPI program launched in 2019.
Sure. Thank you, Richie. And as Richie had said in his introductory speech, that most of the regulators here in India have been trying to relax their norms to try and see as much capital come into India. SEBI too, while of course they relooked at these FII regulations in the year 2014, immediately within 5 years in 2019 as well, again they made a lot of changes in these regulations based on the recommendations of the HR Khan working group. And in September 2019, they came out with these new regulations. Followed by that, of course, there are operational guidelines that they have issued for the use of the domestic custodians and the FPIs. I'll just take you through some of the major changes that SEBI has done in positive way, and of course, a couple of them in negative ways as well. One, of course, is the investment by NRIs. This has always been a point of contention for SEBI and the regulators, that the NRIs have been making investments, portfolio investments under the FPI route, because they always have this separate route available to them under the Reserve Bank of India's guidelines. As all of us know, NRI used to make 100% investment under the FPI regime quite some time back. There were certain concerns raised by SEBI. They stopped NRIs investing through FPIs. They again started allowing NRIs to come through FPIs. But by way of these new regulations, I think now what they have done is they have put a cap on the investments by non-resident Indians and overseas citizens of India to the extent of 25% on an individual basis and 50% on an aggregate. And in fact, they also have allowed now resident Indian individuals to make investment into FPIs with the same caps that are available to NRIs and OCIs. So going forward now, NRIs, overseas citizens of India and resident Indians on an aggregate basis can invest up to 50% in the FPIs. The second change, and a welcome change, that SEBI has done is they have done away with the broad-based criteria. The broad-based criteria, as most of you all may know, is that a fund has to have at least 20 investors with each not holding more than 49%. And many a fund, especially the open-ended funds, have been finding it a bit difficult to fulfill this broad-based criteria, especially at some point of time when investors used to make redemptions, which of course would automatically change the shareholding pattern. And at many a times the FPIs would lose the broad-based criteria. So I think this is a welcome move that SEBI has done. The other aspect that also again a welcome move by SEBI is in terms of the opaque structure. As you all know, SEBI had for some point of time certain restrictions on protected cell companies and segregated portfolio companies, PCCs and SPCs. While of course, initially when SEBI introduced the FII regulations way back in 1995, there have been PCCs that have been registered with SEBI as FIIs and have been making investments. But it seems that at quite some point of time when there were some investments made into India and there was, I think, a major scam which SEBI has disclosed. And when they started investigating into that and realized that there have been some 3 or 4 entities from Mauritius which made investment and which were incidentally PCCs, and that's where they came out with the ban at that point of time, and that continued for quite some time. It was only in the year 2012 that in UK, when the PCC regime was made mandatory for some of the entities, their broad-based pooling vehicles, they're called open-ended investment companies, OICs. And it so happened that most of the OICs were also registered with SEBI as FIIs at that point of time. So while from UK law perspective, they had to mandatorily apply to the PCC norms, whereby the assets and liabilities were ring-fenced. From the SEBI's perspective, those were the restricted entities. And that's where, on behalf of many of the UK entities, we made representations with SEBI. We had a lot of discussions with the senior officials. And that's where at least a partial relaxation was made by SEBI at that point of time, in the sense that any entity which is mandated by a regulator or the government to be a PCC would be allowed to be registered with SEBI as FPIs, subject to, of course, fulfillment of certain conditions, in the sense each sub-fund has to fulfill broad-based criteria, and that they should be able to provide names of each beneficial owner. The other change which SEBI has done from the 2014 old regulations is that from three categories which were there under the old regulations, they basically have simplified it into two categories. In the sense, the category 1 under the old regulations, which belong to the government bodies and government entities, and category 2, wherein all the appropriately funds would fall, was made into one category, that is category 1, and all other categories which could not fulfill the criteria of category 1 were brought under category 2, including the individuals, the family offices, etc. One important thing that SEBI has done into this is that they have introduced this criteria of Financial Action Task Force member countries. In the sense, they have brought certain category of entities, provided they are from FATF member countries, in the sense appropriately regulated funds. And even if there is an unregulated fund, but if it is managed by an investment manager, which is again registered with SEBI, then that would be registered with SEBI as FIIs. While of course from investment limits perspective, there is no difference in category 1 or category 2, in the sense both of them can invest up to 9.99%. There have been certain advantages for category 1 FPIs. That is, they could invest into offshore derivative instruments. There have been certain compliance easing in terms of the KYC norms. In terms of investing into stock or currency derivatives, there are certain enhanced positions that category 1 gets, and there are certain exemptions from indirect transfer provisions also under the tax laws that category 1 FPIs get. And hence a lot of entities then try to see that they are registered as category 1. The other change, of course, and which is an important change that SEBI has introduced, is that in case if any FPI breaches this 9.99% limit and goes beyond that, then they have given two options. One, that they can divest any excess investment within 5 trading days on the rate of investment, or they could convert this investment, the total investment, into foreign direct investment. And this, of course, was a major change that most of the FPIs have welcomed it. But of course, to that extent, considering that foreign direct investment is a domain of Reserve Bank of India, and there have been certain reportings that are prescribed by the Reserve Bank of India as also by the SEBI. What is still not clear is to, if any investment is converted into FDI, how the reporting would be done to, first of all, SEBI intimating that FPI investment is now converted into FDI, separately to Reserve Bank of India also, and who would do that? Would it be the custodians who would be doing it? Because custodians have no link with the Reserve Bank of India. It is the prerogative of the AD banks which deal with all the filings which are to be done with the Reserve Bank of India. So this, of course, is an open issue, along with there are certain other open issues which, of course, SEBI would need to look into. And one very important issue that they still haven't dealt with is the off-market transfers. As we all know, the off-market transfers currently are allowed only for multiple investment managers. That is where there is one fund which has allocated funds to multiple investment managers and which has only one permanent account number. Only such entities are allowed to make off-market transfer, as also in case of illiquid or the suspended shares, the off-market transfers can be done. There are certain circumstances where some large institutional investors who are coming either, let's say, from Luxembourg or from the US and have subsidiaries in Mauritius, which are also funds and registered with SEBI as FPIs. And for certain commercial reasons, now they want to close down the Mauritius entity and take all the shareholding, Indian shareholding, into their parent entity by way of off-market transaction, which is what the SEBI has not yet allowed. But we hope that at some point of time, SEBI would be able to look into it positively. And these are some of the, I think, major changes that SEBI has done into this 2019 regulations. Over to
Sure.
you, Richie.
Thank you. Thanks, Kishore. I think the next point that we wanted to take up was that why did this entire issue around Mauritius become so relevant, and what has SEBI done? What is the path forward, and so on and so forth. So I think to begin with, what had happened is that when the FPI regulations were sort of designed, a lot of reliance was being placed on the KYC carried out in FATF member jurisdictions, of which India is a member. And obviously, India sees the level of KYC conducted in these markets and jurisdictions to be robust enough to meet its satisfaction. Accordingly, what SEBI had done is that at the time of designing these FPI regulations, SEBI said that if an applicant is coming from a jurisdiction which is sort of not meeting the FATF criteria, if there is significant deficiency in the meeting them, or it is not cooperating, they to begin with would be ineligible to even be a applicant for an FPI license. Once an entity determines that yes, it is eligible to be an FPI, the next question that comes up is that under what category of FPI license would it fall? Would it be category 1 or 2? So in that case, like Kishore indicated, category 1 FPIs are meant for, by and large, and we'll focus the discussion on fund type structures. Sovereign wealth funds clearly are category 1. But from a fund universe, what matters is that if the applicant is from a jurisdiction which is member of FATF, either it is itself a regulated, appropriately regulated fund, or even if it is not itself regulated, it is managed by a manager which is itself registered as a category 1 FPI. Now, like Kishore indicated, all the other funds which don't qualify under these parameters would fall within the category 2 FPI bucket. Now, what had happened is that Mauritius, for various practical parameters, is not a member of FATF. And this also meant that entities coming from Mauritius would not automatically qualify as a Category 1 FPI unless they were managed by a manager, which was itself from FATF jurisdiction and was registered with SEBI as a Category 1 FPI. Being a Category 2 FPI also meant that Mauritius-based FPIs could not deal in ODIs, offshore derivative instruments, which are synthetic instruments through which one could track economics of underlying instrument, which are by and large listed securities in India. Now, what it meant was that to begin with, Mauritius-based FPIs could not deal in ODIs. The position limits also available to them under various contract positions, whether it is currency derivatives and so on and so forth, was also in some certain cases limited. But what had hurt pretty much almost all FPIs coming from Mauritius was the stringency of the KYCs that were applied to Category 2 FPIs. The key one being that the moment a beneficial owner is identified, which for everyone's information is on 25% plus basis in case of corporate FPIs, in those cases, each of the beneficial owners will have to also share with the custodian proof of identity, which is not applicable had the FPI been a Category 1 FPI. So the stringency of the KYC norms definitely was something which was a matter of concern for a lot of sophisticated investors and GPs who were marketing the fund to sophisticated investors. Now, obviously, COVID has its own reactions, and while Mauritius and India continue to enjoy extremely great relations over decades for various reasons, what had happened is that Mauritius was still not able to be recognized as a Category 1 FPI, and there was a lot of effort, intergovernmental effort, and exercises which were going on to sort of come to those terms. Now, what happened is that SEBI first came out with an amendment to FPI regulations, specifying that even if a country is not a member of FATF jurisdiction list, if the country is notified by the Indian government to be so eligible, they would still consider it to be part of the Category 1 FPI bucket. And within few days of that SEBI amendment to the FPI program, Department of Economic Affairs (DEA), which is a subdivision of Ministry of Finance, Government of India, came out with an order immediately notifying Mauritius to be the jurisdiction for such purposes. What it meant was Mauritius-based FPI were immediately now have the option to interact and engage with their custodians, the designated depository participants, and roll over to Category 1 FPI. And hopefully, it would mean that any new investments they make, any new positions they take, would be as per Category 1 FPI. Having said that, is it end of all problems, end of all issues for Mauritius? Perhaps no. The reason is that on a very independent note, what had happened is that earlier in the year, FATF had come out with a finding that with a list of jurisdictions which had some unresolved deficiencies in their KYC aspects. Even though there were identified deficiencies, those countries had also sort of agreed to a path within which they would meet the deficiencies and the timeline within which they would meet those deficiencies. Now, unfortunately, fortunately, Mauritius also features in that list, and accordingly, Mauritius, FSC, and the different regulators have sort of come out with position that how there is a robust list of 58 items, out of which I think about 53 odd were already being met by Mauritius, and it is actively working with FATF to resolve even the remaining balance. Having said that, what it still means that because of it being mentioned in the grey list, SEBI had come out with a guidance, which is what is followed by the custodians in India, that when dealing with grey list jurisdictions, they should keep that into account when looking at the KYC. This means that the custodians, instead of applying the 25% plus KYC rules that I mentioned earlier, look at each beneficial owner above the 10% economic ownership when looking at the KYC of the beneficial owners. Now, this is not an issue which gets resolved just because Mauritius-based funds suddenly become Category 1 FPI, because this is an independent issue which can only get resolved when Mauritius is sort of taken out of the grey list and becomes, a more regular country from an FATF perspective. At this point in time, I would like to call upon Mr. Suraj Nundlall, who is a senior executive from Economic Development Board of Mauritius. Maybe Suraj, if you are able to access the WebEx now, if you could maybe update us and the participants on the WebEx on what is the current status for Mauritius vis-a-vis FATF, and how do you see the path forward rolling out?
Okay, thank you, Richie. So first of all, I would like to thank Nishith Desai NDA to invite me. So thank you, and thank to NDA to give us the opportunity to be part of this webinar at this point in time. And I hope all of you participants are very safe at your place and keeping healthy during these times. So basically, I'll take you back to the mutual evaluation report that was done on Mauritius by the ESAMLAG. ESAMLAG is the Eastern Southern African Anti-Money Laundering Action Group for Africa, whereby there are, of course, many points that are discussed during these review meetings, and whereby in 2018, the Council of Ministers approved Mauritius, MER, that is a mutual evaluation report on Mauritius. And there were a few shortcomings there. And so these shortcomings were addressed eventually by Mauritius, because ESAMLAG is also part of the FATF, that is the Financial Action Task Force. So just to take you on one of those points where there are technical requirements, technical compliance, which the MER worked upon and then gave their findings, their recommendations and all that. So just to tell you that one of the shortcomings that they identified were that there are restrictions in relation to sharing of information between competent authorities, and also the disclosure of information between FIs, that is financial institutions, limited to information related to assessing the creditworthiness. So, and then when the review was done, then the MER report mentioned that the information is required to be disclosed by the financial institution for the purpose of complying with their duties in relation to the prevention of money laundering and terrorism financing under the Act. With respect to payable through accounts, the customer due diligence information is required to be disclosed to another institution with which it maintains a correspondent banking relationship, provided that the institution has given a written undertaking regarding the confidentiality of the information provided. And the third point was that the customer due diligence information is required to be disclosed by the financial institution for the purpose of meeting the requirements set out by the bank with respect to domestic or cross-border wire transfers or reliance on a third party. And then so this was done, and then what they said that Mauritius has addressed all the deficiencies which was identified for this specific recommendation in the mutual evaluation report. So just to say that we became compliant like this with most of the points that was raised at the ISAMLAG review meeting. And then from there, we come to Financial Action Task Force. When we look at what happened there is that the February meeting that took place in this year, so the FATF considered the progress that Mauritius has made in improving its technical compliance with the FATF recommendations and increasing the level of effectiveness of anti-money laundering and the CFT, that is countering the financial terrorist system during the period of the observation, which was between October 2018 up to October 2019. Now in the FATF, so the action points, there are in all 40 action points plus 9 recommendations. So of these 40 action points, 1 year previous to the review meeting that happened in February this year, so we were compliant only on 14. So we were only compliant on 14. But 1 year later, we became compliant on 35. So which shows the commitment of our government to improve the system and to be compliant at an international level. So we have been following the guidelines and everything to become compliant at that level. So now we are left with 5 action points that need to be complied with, and Mauritius has taken the commitment, the highest level commitment vis-a-vis the FATF, that this is going to be completed, and hopefully, I mean, all depends on how this COVID situation evolves. But hopefully, if everything goes well, then by the end of this year, we will be compliant on the 5 action points that are remaining, so that Mauritius will be out of the gray list of the FATF. At the same time, we have also taken the necessary measures to amend the regulations, the laws, and everything, so that everything is done in compliance with the international norms, including the FATF, the OECD, and all those AML and all that. Yeah. So,
Thank you, Seewraj. I think the feedback that I take from what you said, and which would be of great interest to a lot of the participants on the call, is that what we understand is that there is an identified path to achieve and meet all the remaining FATF asks which are pending, and the path is expected to be achieved by end of this year 2020. Yes. So hopefully by first quarter next year, hopefully Mauritius would be both a Category I FPI and B, without the tag of being a grey list jurisdiction from an FATF perspective.
Yes.
I think that obviously is a lot of relief to a lot of existing Mauritius-based FPIs, as well as those who have been contemplating Mauritius as the jurisdiction for setting up a new FPI, so on and so forth. Thanks a lot for that insight. I think here we will change tracks and we will come to comparison of jurisdictions sort of from a perspective that how they sort of compare when somebody is setting up a new fund from a GP perspective. I think here what is great about Mauritius has been that over the years, and we have been advising several institutional GPs raising capital from institutional investors, sovereign wealth funds, DFIs, and so on and so forth. There has been an increasing acceptance for Mauritius as a jurisdiction. Till quite a few years back, until some time, there was always a question that would Mauritius be acceptable to the LP base or not. Now, till the grey list issue sort of broke out earlier this year, it's very heartening to see that Mauritius has been accepted by the investor basis. The law also we found to be very conducive to write the right amount of governance framework for setting up funds, and the LP-GP relationship could be covered under the same sort of framework which LPs or GPs are used to seeing in a Cayman type fund or a Delaware type fund. And accordingly, this also obviated the need to set up feeder vehicles in those jurisdictions because the GP found that the LPs are comfortable, and accordingly, the entire pooling of LPs could be achieved in Mauritius, and the vehicle itself could directly make investments not just in India under the FPI program or the under different FECI programs or FDI programs and so on and so forth, but also in a lot of other jurisdictions with which Mauritius continues to have excellent investment relationships, tax-ready network, and so on and so forth. With that, I think I would like to bring in my colleague Parul Jain. So Parul, for you, I think the question was to begin with, how are FPIs taxed? What is the position for Mauritius now? And also, if a fund manager was out there looking to set up a fund, is Mauritius the only obvious choice, or are there any other comparable jurisdictions that you hear GPs talking about or LPs asking for, which become compelling choices other than Mauritius?
Yeah, sure. Thanks, Richie. Thanks a lot for, looping me in. So obviously, when we set up any structure, tax always comes in, as a number one question mark, what is going to be the tax leakage in the structure? And FPIs have had a kind of, a very, romantic relationship with tax authorities, let me put it like that. And a lot of, circulars have come in for FPIs, a lot of clarifications have come. They've got some things, they've not got some things. The position where FPI taxation is concerned today is that FPIs, when they invest in securities in India, then the gains that they earn on account of sale of those securities is regarded as capital gain income. Now, traditionally, these FPIs were coming from Mauritius because the Mauritius Treaty had, capital gains tax exemption for any gains that were derived from India. Of course, so did Singapore and, one or two other jurisdictions, but Mauritius was much easier to, to set up a vehicle administratively. There's a good support system there. The political climate also works to an advantage. So given the whole, and Mauritius is obviously, it is developing itself as a financial center, international financial center. So it was not really, a big surprise that, we saw a lot of FPIs actually setting up their shop in Mauritius. And of course, when they invested in India, then they got a capital gains tax exemption. In fact, there was a circular which was specifically for FPIs, which said that as long as FPI has a tax residency certificate from Mauritius, they will not be subject to tax in India. Come 2017, the tax treaty in Mauritius changed, and the capital gains are no longer exempt from tax in India. And there is a 10% tax which needs to be paid by the FPI when they sell their securities in India. And of course, there was another change for listed securities that, FPIs, when they're investing in listed securities, they would be investing listed securities. So those would also be subject to tax in India because the listed security capital gains tax exemption under the Indian tax law was removed. So actually, when you look at it, FPIs were not really getting a tax advantage from Mauritius where capital gains tax is concerned. But since, they have been operating from Mauritius for quite some time, they did not really see any reason to migrate to any other jurisdiction. There is also a law for indirect transfers, and typically in an FPI situation, FPI funds would be open-ended mainly. And the question that would come up is that when investors are redeeming their units in the FPI entity, then do they have to pay a tax based on the indirect transfer rules in India, which were introduced after the famous Vodafone tax case. I won't go into the technicality of what an indirect transfer is and how capital gains tax is levied, but in order to assuage the FPI concerns, there was an exemption which was built in the income tax law, which said that if any non-resident has invested directly or indirectly in a Category I or a Category II FPI, then the indirect transfer rules will not apply to any transfer of the securities of the any transfer of the securities which derive their value from India. When the change in September happened, where the FPI regime changed, and a lot of the Category 1 and 2 license changes happened, and Mauritius, which was anyway a Category 2, and it continued to remain it was Category 2 under the 2019 change. What the tax authorities did was that in the budget that happened in February of this year, they proposed a change stating that the indirect transfer exemption will be available only to Category 1 FPIs. And I think this became a very big reason of concern for investors, because FPIs who could not qualify as Category 1 and were by default a Category 2 FPIs, if there would be any redemption of shares or any securities at the top level, which is something which happens very commonly for FPI structures, then there would be an indirect transfer capital gains tax that would be required to be paid in India. So I think that's the controversy that happened, and probably, at least for Mauritius funds, with the with adding Mauritius as an eligible jurisdiction for Category 1, at least, most of these funds, depending on their structures, if they're able to get the Category 1 status, then at least, the indirect transfer exemption will continue to apply to those funds with effect from the date that they're able to get the Category 1 status. So I think that's what has happened, where at least, the direct impact on tax for the changes in the, in the FPI rules is concerned. In the meanwhile, we also saw that, a lot of FPIs have also been looking at other jurisdictions and migrating to other jurisdictions. Maybe the Category 2 license would be one of the reasons, but nonetheless, the other bigger reason could also be that there are other countries like France and Netherlands, which are also good fund jurisdictions, at least for, public market funds that are set up. And funds started, FPI started evaluating those jurisdictions purely from the perspective of, taking advantage of the tax treaty which India has with those jurisdictions. Now, in a typical FPI scenario, FPIs would hold less than 10% of securities of an Indian company. And there is what we call a participation exemption, which is given in, in a few countries which India has with, in a few treaties which India has with a few countries, and France and Netherlands are a couple of those countries, where if, a French FPI is selling shares of an Indian company, and, the French FPI is holding less than 10% in that case, then there is no tax in India because of the participation exemption, which is provided under the India-French tax treaty. So we did see, quite a few FPIs that were moving from other European jurisdictions as well as, from Mauritius, and looking at, taking advantage of those tax treaties. The way that we would really look at it is that, of course, there has to be a commercial rationale for the move. to other jurisdictions, even though those jurisdictions may fare better from a tax treaty perspective because of the participation exemptions. And, possibly, Richie, just to take your question in consideration and, looking at all the conversation that we've been having over the last, 35, 40 minutes, is that the fact that Mauritius, FPI is based to a higher level of KYC, or the fact, at least before this order came out, Mauritius entities were, not being eligible for indirect transfer benefits, and they were being, shortchanged in that context. Maybe that's also sufficient reason for them to move to jurisdictions like France and Netherlands. But again, that's a very big question mark also from a GAR perspective and also from a principal purpose test perspective, which is currently the new GAR in tax treaties under the MLI, which has come into effect from, with India, from last year, but effective from April of this year. And I think there's a question that we have on the sideboard, which I can quickly just take up. How did the change in budget change tax treatment for investors of FPIs based out of Mauritius? I think this is what I spoke about, that they were no longer eligible for investors in FPIs, were no longer eligible for an indirect transfer benefit. So if they would have sold shares of an FPI entity, which was deriving value substantially from India, they would have to pay tax in India. But however, with this change that has happened now, if the Mauritius FPI is going to get a Category I license, then, going forward, they would still be, investors would still be eligible for the indirect transfer exemption.
Parul, I think with that, I would just like to add a perspective that if somebody is still out there trying to design a structure for onboarding LPs, I think obviously it's very interesting time today to look at what all different jurisdictions are offering. One interesting feature we have seen is that there has been a global push towards ring fence structures. This all started after GFC, when there was a lot of spillover of liabilities for a fund, just because the alongside class structure had incurred some liability. What has happened is that different jurisdictions, be it Singapore, Hong Kong, Cayman, etc., have been pushing towards their own version of a ring fence structure. Traditionally, Mauritius has been offering the protected cell company, the PCC model, which, like Kishore indicated, has now been found to be eligible to be onboarded as an FPI. What these models do is they allow the fund manager to look at segregated portfolios and launch different strategies within the same vehicle. This obviously achieves efficiencies of scale, because every time you want to launch a new strategy or onboard new LPs on a segregated basis, you don't have to set up a new fund, but you can always set up a new cell, which can be issued by amendment to governing documents and passing relevant resolutions. But more importantly, this will also allow the fund manager to offer tracking structures where an LP can sort of come in, have a clear understanding with the manager what sort of portfolio construction is intended to be achieved. So the PCC could invest directly under the FPI program, or it could even invest via an AIF or some other vehicle in India, so that you can get the best of the entire Jain. Now, Singapore has come out with its own version, which is called a variable capital company, modeled similarly around this PCC format in which operates in Mauritius. But the interesting part is that of the different sub funds that are launched in a VCC type environment in Singapore, the expense criteria, the other criteria that need to be met to be an exempt fund under the 13R, 13X programs, they can be met on an aggregate basis, so that no single sub fund needs to meet the criteria, which obviously helps in case a tracking sort of structure is intended to be designed. Now, those vehicles also, like I indicated earlier, offer segregated portfolios, but now are also eligible to register as an FPI. Now, FPIs, I'm sure the participants are aware, are not just about buying and selling securities on the stock exchange, but they can also very effectively be used for subscribing to non-convertible debentures, NCDs, which has been an instrument of choice, even when looking at unlisted type opportunities and so on and so forth. So I think interesting times. With that, I would also like to inform the audience that we have a chat window, and please do keep populating your queries so that we can take it up as we go along. But while we do that, I think now I'll turn to Nandini. Nandini, I think there has been a recent press note that was issued, which sort of summarized that how any foreign investments coming from a neighboring country would need prior vetting by the government. Could you explain the circular to us, and also sort of what you see could be an impact or a potential impact on FPIs that you foresee could be in the coming days?
Sure. Thanks, Richie. So, yes, 3 days ago, the DIP released a press note proposing to change the FDI policy, which has been in place since 2017 as is. While the press note has not immediately come into effect, it is supposed to come into effect upon its FEMA notification. The press note suggests that an entity of a country which shares its land border with India, or where the beneficial owner of an investment into India is situated in or is a citizen of such country, then they can only invest in India under the government route, which means with prior approval of the government. So at the outset, the circular may seem irrelevant for say the FPI audience because it concerns itself with the FDI policy. But if we really look at it closely, it could apply to FPIs whose holding is not less than 10%, and therefore the excess is being recharacterized as FDI under Indian exchange control laws. But I think the big question that everyone is asking right now is whether Hong Kong would get covered in this circular. And while this remains an unanswered question, one way to look at it is that how the Civil Procedure Code and how the Indian Arbitration and Conciliation Act look at execution and enforcement of foreign decrees in India. So both of these statutes have a list of recognized countries where they have reciprocity arrangement to enforce foreign decrees in India, and they actually look at China and Hong Kong separately. So these are two separate sort of countries. While Hong Kong is not a country, these are two separate countries listed down in the schedules for both these statutes in India. So my understanding is one way to look at it could be that India looks at Hong Kong separately from China from a judicial enforcement perspective, and therefore Hong Kong investors should not be falling in this circular. But it's difficult to conclude one way or the other until the government actually clarifies.
Sure. Thank you. I think a couple of points from that circular or the press note, which are of some interest to a lot of audiences, is the use of the expression beneficial ownership, which is the threshold basis which entities may get screened if the beneficial owner is from a neighboring country. So I think what is interesting is that while the FDI policy does not per se have its own definition of beneficial owner, FDI policy does, in a sense that if the investment is into a private company, you look at the definition under the Companies Act, which is 10% plus control, or alternatively control. Whereas in case of FPI regime, it is 25% plus ownership in case of a corporate structure, control or ability to sort of construct the board of directors of the FPI, or alternatively, if no beneficial owners is identified on these bases, you may need to point to the senior management officer SMO of the FPI. Now, if one were to think that the circular was also going to be applied on FPIs, perhaps we would have to wait for a formal circular to be released by SEBI. We would also need to make sure that SEBI is able to segregate data on beneficial ownership and hopefully only identify those FTIs which have a neighboring country appearing up as a beneficial owner jurisdiction, strictly on the basis of ownership as opposed to senior management officer. Otherwise, there may be some debate on what was the objective of the press note, the SEBI circular, what are you trying to screen, and what is the basis. The second aspect is that while FPIs look at beneficial owners on a 25% plus threshold, like Nandini indicated, if the FPI were to exceed 9.99% ownership in the Indian company. And by the way, 9.99% is on the basis of even combined basis on different FPIs which are part of the same investor group, or even ODI exposures that the same investor group could take could be clubbed with FPIs. Now, the moment they trip over 9.99%, like Nandini indicated, the entire investment could be reclassified as FDI, which would otherwise then trigger a lower sort of threshold to determine the beneficial owner. So how does the transition of beneficial owners happen? Because when the entity was an FPI, or when the investment was being tracked under FPI regime, you were looking at 25% plus threshold. But suddenly, the moment the entire investment got reclassified as an FDI, would you revisit the BO disclosures already made and then start looking at it with a newer lens that, look here, now we need a revised beneficial ownership disclosure from the entity, because now under the FDA program, we perhaps would like to apply a different threshold. So I think there are a lot of issues that can come up if this circular were to apply to FPIs. This is not even to say that there are not too many issues already, even when it is being applied to FDI program, because it concerns not just direct investments into India, but even downstream investments where an existing Indian entity has already absorbed foreign investment and is making a downstream investment using an FDI instrument like convertible debentures or equity shares. But this could also be of some relevance if the manager or sponsor of an AIF is foreign owned or controlled, in which case even downstream investments by those AIFs could suddenly be seen from the lens of the new press note. What is interesting is that could it mean that if the manager sponsor is foreign owned controlled, would they then perhaps put a risk factor that, okay, we cannot take investors who are coming from a neighboring country? Again, those are gray areas. That how will you sort of look at the beneficial ownership? Would you look at manager sponsor, or would you look at the LP composition of the AIF? Again, these are issues. There can be views. There could be arguments on either sides on how to look at it. But again, that is not what a jurisdiction would aim for or look for, especially when it is on the cusp of being directed hundreds of billions of dollars, just because of the point we originally made that globally, a lot of countries are realigning the supply chain, and India could be a significant beneficiary of these realignments on the global order. So the least one could hope for is that India would put together a very clear-cut legal regulatory framework which gives certainty to all investors and participants, not just in the long term, but even from a short to medium term perspective. And these changes of law, obviously, there are motivations behind it. Globally, there's been a push to look at any strategic investments coming from a neighboring country. But at the same time, how these laws are implemented, I think will be very evenly and very keenly be watched at. So with that, I think we will again look at the questions that have queued so far in the chat box. So I think, Parul, there's a question from Vipul Soni saying that Mauritius has still not deposited treaty with OECD, and thus PPT rule and MLI would not apply. Is that correct? Would you like to take that?
Yeah, sure, Richie. So that's correct. Mauritius has not actually also notified India's treaty as a cover tax, agreement for the purposes of applicability of MLI, and so therefore the PP2 rule does not really apply to Mauritius. However, the GAR will still apply. In the context of FPIs, there is a clarification saying that if FPIs are not taking a tax treaty benefit, then GAR does not apply. But I think one important point here that could be is that there is a grandfathering from of treaty benefits, which is available in case of Mauritius, and this is for investments which have been made till 2017. If there are any FPI positions that were taken prior to 2017 and they are sold after 2017, then the Mauritius India treaty, in capital gains tax exemption would still be available. However, if and whenever Mauritius notifies India's treaty as a cover tax treatment, I think the question as to whether the PPT rule would apply even for grandfathered investments remains an open question. And while there may be some technical arguments around it, but probably that's the next, change to watch out for where Mauritius is concerned.
Thanks, Parul. I think the next question we can take up is from Anand Shah, where his question is that in order to check FI flows from China, SEBI has recently changed guidelines. Will such acts have an adverse impact on FI and FDI flow? I think we took that, Anand. I think hopefully that answered your question. The perspective was that yes, there are motivations. Obviously, no jurisdiction today would like to sort of make rules which are difficult to implement or difficult for the investor audience to understand. So we will really have to wait and watch and see how further details around the press note are sort of issued, and and then accordingly, come to some conclusion and advice to the investors. I don't see any other questions out there in the queue. So with that, maybe Seewraj, if you want to have the last word, anything you want to leave the audience with, anything new that you see in Mauritius, any new discussions from the government on the current environment?
Thank you, Chi. So what I can tell you is that what I can say to the participants is that government, Mauritius is always committed to to welcome investors from all over the globe, whether it is for investment into India or even investment outside India. So basically, the way our jurisdiction has evolved over the last couple of years is that after the treaty review between India and Mauritius, so what we did, we took a shift in the strategy. That is, we started looking more regionally, and excuse me. And so today, Mauritius has become the main gateway for investment into Africa. So when you're looking at cross-border investment in Africa by global investors, so their natural choice today is Mauritius. And like this, so today around 40% of the global funds that are invested in Africa, so around 40% of that is going via Mauritius today. And this number keeps on increasing. So I think from that perspective, it's an interesting time for not only for Indian investors who are looking beyond India, but all other investors, whether they want to pool their investment in Mauritius for investment into India, or even from Mauritius for investment into Africa. So it's a common place for all these investors to look at from a perspective, from a jurisdiction perspective, because the treaties that we have with Africa also helps them to take benefits of the taxes, all the different benefits that are available. And in terms of the ease of doing business, we know that Mauritius is already there trying to improve year by year. Today we are globally we are ranked number 13. So, and every year we try to improve that also. Yeah, thank you.
All right. Thank you so much, Seewraj. I think with that, we come to an end of our WebEx session today. Again, would like to thank my fellow panelists and also all the participants who sort of made time to attend the session. We hope that you are leaving this session with a better understanding of all the recent developments, all the issues that we have been facing, not just from an FPI perspective, but more broadly from a investment into India sort of a framework.